So on the business transactions, let us revise or brush up what we have already done. A business transaction to be recorded, to be booked or to be accounted in the books of account, it must be measurable in terms of money. We call it the money measurement concept. Measurable in terms of money. It must have a financial worth. It must have a monetary or a financial impact on the business. There is an expense or an income. So that's the first principle, that an income, that a business transaction, should be monetarily measurable. It must be money measurable. The second was the dual aspect. Dual, double or twofold. The dual aspect concept. Every transaction affects two things. The identification of those two things is the beginning of accounting. And those two things are normally the two accounts, one of which is debited and the other is credited. So the money measurement concept, the dual aspect concept. The third aspect was the accrual concept. Since we are accounting transactions for an accounting period, and the business is a continuous process. For example, if it is a manufacturing concern, you continuously purchase input, make payments for them, convert them into the finished products, pay wages for the purpose of that, incur overhead expenditure, and finally these finished goods are sold. This is a process, it's a cycle which continues to go on. In between, let us say once in a period of 5 years, 6 years, 10 years, there is an expansion done. There is a diversification to another line of business. So business is a continuous cycle for which the accounting must be cut off. And you measure income, expenses, profit or loss, financial position, etc. for a particular accounting period, which forms the benchmark, which is usually the period of a financial year. The period of 12 months, commencing on the first day of April in a year and ending with the 31st day of March of the succeeding year. So when you are closing in, or when you are covering all the incomes and expenses, payments or receipts, accruals for a particular accounting period, everything pertaining to that period must be completely covered. I was giving the example of wages or salaries which is due for the month of March. On the midnight of March 31st, our accounting period ends. But on the midnight of 31st March, the salary or the wages for the month of March would not have been paid. The rent for the month of March would not have been paid. An income in the form of interest, for example, on a deposit, on an asset, may not have been received. They would be received only subsequently or paid only subsequently. Let us say in the first week of April. However, when you receive it in the first week of April or paid in the first week of April, you must bear in mind that this actually pertains to March. So on 31st March, there must be an accounting entry to record this particular accrual or due receipt or payment. That is called the accrual concept. Only then the incomes, expenses, assets and liabilities of the accounting period of the financial year are completely reckoned or accounted or booked. So that is the third important principle in accounting. Accrual. So money measurement concept of accounting, dual aspect concept of accounting, and the accrual concept of accounting. Are these three important guidelines on which accounting is done. And the fourth was the distinction between cash and credit. So these three are concepts or principles. The distinction between a cash transaction and a credit transaction. Any item of expenditure or income for which cash may not have flowed out or in immediately or completely. Those transactions are also to be accounted for, just like the accrual principle for incomes not yet received but due, or expenses not yet paid but due. Similarly, a credit transaction is a non-cash transaction, non-payment, non-receipt transaction. It is a transaction for which the amount is promised to be paid or received in future. Whereas in a cash transaction, the amount is paid or received on the spot as soon as the transaction happens or occurs. So this is the fourth important underlying principle in accounting for a business transaction. So money measurement, dual aspect, one of which is debit and the other is credit, accrual, and cash versus credit. These are the concepts we are going to incorporate and learn the accounting of basic transactions. So they have to be applied appropriately. Those principles have to be utilized in accounting for business transactions. So these four are essential in the accounting of business transactions to make them complete, to make them exhaustive, all-inclusive for an accounting period. Now, moving on. The dual aspect concept indicates that every business transaction affects two items or two accounts. It could be an income, it might be an expenditure, it might be a payment, it might be a receipt, it might be an accrual. Ultimately, a business transaction results in at least two. One debit and one credit, or some debits and one credit, or one debit and some credits. Ultimately, there are at least two transactions involved. So, two accounts involved, or two factors involved. Now, these factors will ultimately become accounts. When I commence capital with a cash of 1 lakh, I have capital, proprietor's capital, and cash. These are the two, the dual aspect. So, capital account, cash account. I pay wages or I pay salaries. Salaries account, cash account. I deposit money in a bank. Bank account, cash account. So every transaction involves the double-fold aspect or the two-fold effect or impact. Now these two items, the two factors which are affected, are termed as accounts. So we have a lot of accounts. Purchases account, sales account, bank account, cash account, capital account, investments account. So all these are suffixed by the term account. Each one becomes a separately identifiable account or record for the purpose of bookkeeping or accountancy. Now these accounts are broadly of two types. Which account is to be debited, which account is to be credited? In the analysis of that particular process, there are principles applicable, there are rules applicable to each of the accounts. To analyze the rules, it is necessary to understand that accounts are broadly of two types. One, the personal accounts, and the other is the impersonal accounts. As the name indicates, personal accounts are in the name of a person, and impersonal accounts do not involve a person. For example, the name of a person, a party as we call it, a bank, an institution, a company. Personal accounts are those accounts which are opened in the names of persons, whereas impersonal accounts are either expenses or incomes or assets or liabilities. So the impersonal accounts are further split into real accounts and the nominal accounts. So effectively, in an accounting transaction or in accounting for a business transaction, there are three accounts: personal accounts, real accounts, and nominal accounts. A personal account is an account opened in the name of a person. It could be a debtor. When does a debtor arise? When a sale is made on credit, that is, cash is not received immediately. It is promised to be paid by the debtor on a future date. So a debtor is a person who owes money to the business, or it could be a creditor, a person to whom the business owes money in respect of a purchase, in respect of an expenditure, where the transaction has happened but the payment for the transaction has not been effected. Or it could be a lender or a borrower. I open an account with a bank, or a bank gives me a loan. When the bank gives the business a loan, my business a loan, the bank becomes a lender. Whereas when I give a loan to another person, a partnership firm, a company, a society, that particular entity or party is a very commonly used phrase, is my borrower of the business. Again, it's an entity. So personal accounts are those which are opened in the name of a person who could be a debtor, a creditor, a lender, or a borrower. So a debtor and a borrower have the same accounting effect. They are persons who owe money to the business. Similarly, a creditor and a lender are on the same footing. They are persons to whom the business owes money. A real account involves an asset or a liability. Cash account, furniture account, plant account, machinery account, computer account, buildings account. All these being assets are real accounts. They are called the real accounts. So a real account is an asset of the business. An asset is a factor used in the continuance of the business. And assets are items which are not meant for resale in the ordinary course of business. For example, stock in trade, inventory. When I purchase raw material is meant to be converted by a manufacturing business into finished goods and then sold. So raw material is strictly speaking not an asset as such. Whereas look at machinery. A machinery is used in the process of converting input into output which is sold. I don't sell the machinery as such unless the business is a dealer in machinery. So my machinery is an asset only meant to convert input into output and sell on a continuous cycle. So a machinery is an asset. The car which is used for traveling, the building in which the business is carried on, a computer system in which I maintain my accounts, all of them are relatively long term as far as their usage or pertinence is concerned in the business. They do not have a quick turnover. Technically, therefore, those are assets which are not meant for resale in the ordinary course of business. The other is a nominal account. A nominal account represents expenditure or expenses and incomes. Purchase account is a nominal account. Sale account, rent account, salary account, interest account, royalty account. All these are either expenses or incomes and therefore classified under nominal accounts. So every account, what is an account? An account is one of the two legs, one of the at least two legs in an accounting transaction. A transaction throws up the dual aspect. So depending on the rules applicable to these three accounts, a personal account, an impersonal account further divided into real and nominal, there are rules which are created over time to decide whether that particular account is to be debited or credited. So to apply the rule, you need to classify the account first. An account could be personal, real, or nominal. So here you have the debtors, the creditors, the lenders, the borrowers. Here you have the assets, the liabilities. Here you have the expenses and the incomes. There can't be anything else. So ultimately there are only 6 accounts, one of which is the basis to put an account into when the transaction is being recorded. Either a payable or a receivable, payable, receivable, asset, liability, expense, income. So anything that comes up in an accounting transaction, in a business transaction, must be put into one of these 6 accounts, types of accounts, and the appropriate rule is applied to decide that yes, this account has to be debited, this account has to be credited. So now, given an account, you must be able to determine whether it is a personal account, a real account, or a nominal account. Personal account, names of persons. Real accounts, assets and liabilities. Nominal accounts, incomes, expenses. Expense or expenditure. So now we are building our accounting study into the 6 other aspects. Money measurement, accrual, dual aspect, cash versus credit, personal account, real account, nominal account. Let us see if we are able to identify the classification when I give you certain accounts. I will make up certain accounts which are thrown up in a business transaction, and let us see if we can give it the correct classification into personal, real or nominal, as the case may be. Let me take an example of one. Rent. Rent account. You can use the abbreviation A/C. Rent account. ICICI bank account. Take a third one. Royalty account. 4. Furniture account. 5. Parkinson's account. Let us say it's a debtor. Mr. Parkinson's account, or let us say the next, purchases account. Next, 7, sales returns account. I'm just at random picking up some accounts. Loan account. 8, 9, capital account. 10th, let us say one more account for us to be familiar. Let me take an example of company, L&T company account. I have 10 accounts. Now we need to classify them. Are they personal, real or nominal? Look at the first. Rent account. Rent is not the name of a person. Rent is not an asset or a liability. It is an expenditure. And an expenditure is a nominal account. ICICI bank account, a bank with which I have my account. I have my savings account. I have my fixed deposit account, time deposit account. It is a person. Person's personal account. Royalty, let us say royalty is an income. I have a patent right or a copyright or some sort of an intellectual property right, based on which I have allowed another person to copy my design or my manufacturing process, for which I get a monthly or periodic income by way of royalty. So royalty is an income. An income is classified under nominal. Nominal accounts cover incomes and expenses. Real accounts cover assets and liabilities. Personal accounts cover, to put it in short, debtors and creditors. The next is furniture account. A furniture is an asset which I use in my business. The tables, the chairs, the AC, the television, the sofa set, the dining table, the book rack. Furniture is an asset. Asset is real. A real account. One of the impersonal accounts. Parkinson's account. Parkinson is a person to whom the business owes money or from whom the business is owed money. Personal. It is in the name of a person. Purchases account. It's my expenditure. A purchase account is an expenditure. I will have to pay money for it, either immediately or deferred. So that becomes a nominal account. You're learning how to classify an account. Once you classify the account, we will have to apply the principle next. Sales returns account. I have sold a consignment. A part of the consignment is defective. That has been returned by the debtor. Sales returns. If sales is an income, sales returns is either an expenditure or a reduction in income. Nominal. Loan account. Loan from HDFC, loan from SBI, loan from Union Bank. A loan is a liability, a personal account. Capital account in the name of a person. Mr. X's capital account. Richie Rich's capital account. So the capital account being the name of a person, personal. And L&T again is the name of account. So identify the account which is affected, of course, based on the 4 principles, and classify it to determine the correct accounting treatment. Is it a personal account, a nominal account, or a real account? So those are the different types of classification. So whatever account that is thrown up in a business transaction would be classifiable into one of these 3. We'll wind up with that for this session. Continue now.